Welcome back to the session once again. Now we are going to discuss cost concepts, including marginal costing and break-even analysis. This is kind of a quick refreshment for all of us. We all understand these cost concepts just to be on the same page because we are going to discuss marginal costing as well and how the marginal costing is used for the purpose of taking a lot of pricing decisions and also for the purpose of profit planning. From that perspective, cost, as we all know, can be understood in from three different angles. Number one, it can be understood from the perspective of nature and traceability. So, what is the cost from the perspective of nature? It can be direct cost and it can be indirect cost. Now, there is no need to get confused and worry about as to how to differentiate between the direct cost and the indirect cost. And the answer, of course, is very simple. A cost that goes directly into making of a product or delivery of a service is a direct cost. As simple as that. A cost that goes directly into making of the product is the direct cost. And what is indirect cost? A cost that is not a direct cost is indirect cost. And why? Because there is nothing in between. So either it's a direct cost or it is indirect cost. There is nothing called semi-indirect cost. And this is how we should understand. So direct cost is one that goes directly into making of the product or service, direct cost. All the other costs that are incurred by a business in its operations are referred as indirect cost. The cost can also be looked at from the function point of view. So from the function point of view, we would call the prime cost and the overheads. So the direct cost is also referred as prime cost. And you can understand, direct cost is the cost, direct cost is the cost which is going directly into making of the product. And therefore, obviously it is the prime cost. It is the main cost. So that is number one. So in case of prime cost, what are the components? The prime cost has got three components. Number one, direct material, direct labor, and direct overheads. So the raw material that we are using for making car or vehicles, that is our direct material cost. The people who are the workers who are working on the shop floor or in the production facilities, helping the production to happen, their cost is part of the prime cost. So that is the direct labor, which is the part of the prime cost. And direct overheads. So all the expenses which are being incurred for facilitating production, and those are facilitating the production, those are the direct overheads. So that is the prime cost, that is direct labor, direct material, and direct overheads. Other than the prime cost, the other expenses, and that is indirect cost, it is also referred as overheads. So overheads can be for factory overheads. So factory overheads will be partly will be relating to production and partly maybe relating to the administration. So the expenses which are being incurred in a factory, which are not directly contributing to the production of the vehicles, of the products, those will be referred as overheads. So factory overheads, office overheads, and selling and distribution overheads. So this is how we can classify the cost between the prime cost and the overheads. Then cost can also be understood from the perspective of variable cost and the fixed cost. So variable cost and the fixed cost. Now what does it mean? What is a variable cost or what is a fixed cost? Let's understand with the help of a graph. So this is your variable cost, as you can see it on the screen. So what you see here, your variable cost, please remember, in totality, it will increase with the increase in the activity level. Variable cost, in totality, it will increase with the increase in the activity level. But in terms of per unit, it is going to be fixed. So the car that we produce or the trucks that we produce or the vehicles that we produce, for every vehicle we know that there is a material cost which is fixed for that particular vehicle, because we know the bill of material. So based on the bill of material, we will know what is the material cost that company incurs on this particular model. So that material cost is fixed whether you produce 10,000 vehicles or you produce 50,000 vehicles or you produce a lakh vehicles, doesn't really matter. In terms of per unit, it is fixed. But in terms of totality, more the cars you produce, the total variable cost will keep on increasing. So it will keep on multiplying with the number of number of vehicles that you produce. So that is your variable cost. Remember, variable cost in terms of totality, it increases with the increase in the activity level, and in terms of per unit, it remains fixed, it remains constant. What about the fixed cost? What are the characteristics of the fixed cost? The characteristics of the fixed cost are diametrically opposite. What does it mean? It means the fixed cost is fixed irrespective of how much you produce or even if you don't produce. For example, you have constructed a building and you have put in plant and machinery into it for making 1000 cars a day. Now, whether you are making 1000 cars a day or you are not making 1000 cars of the day, depreciation cost is incurring in any case, which is fixed. Likewise, for constructing this plant, you must have borrowed funds. So, whether you produce or you don't produce, interest cost on that loan is going to be there in any case because the interest cost on the loans is going to be fixed. So, the characteristics of the fixed cost, number one is it in totality it is fixed. It remains same irrespective of the activity level. But in terms of per unit, the fixed cost in terms of per unit will keep decreasing as you keep on increasing more output. So जैसे जैसे आपका आउटपुट बढ़ेगा उसके हिसाब से जो आपकी per unit fixed cost है, it will keep coming down. Why? Because now when you are increasing the volume, the same fixed cost is getting distributed over a larger volume, and that is why the per unit fixed cost will keep on coming down. Friends, this is very critical for us to understand because this difference between the fixed cost and the variable cost, and this fact that in manufacturing invariably we will have the fixed cost and the variable cost, this information is of a great significance for us in pricing decisions, in break-even decisions, and also in profit planning. Before we come to that, let us understand once again as to what are the elements of and types of overheads. So as we have seen already, just a quick summary. So material cost can be direct or it can be indirect. Labor, it can be direct or it can be indirect. Other expenses can be direct or it can be indirect. So when the direct cost is referred as prime cost, the indirect cost, whether this is material or labor or other expenses, they are referred as overheads. And broadly, overheads in any organization can be production overheads, administration overheads, selling overheads, and the distribution overheads. So this is the basic structure, friends, as far as the cost elements are concerned, types of costs are concerned, or types of overheads are concerned. I would like to highlight here to remember always that in any manufacturing organization, there is a fixed cost and there is a variable cost. And this fixed cost, though it is fixed, it can give you an advantage when you are increasing your volume. When you are increasing your volume. So the fixed cost that you have, even though the fixed cost is dangerous. So when I say dangerous, that means fixed cost is a fixed liability because whether you produce or you don't produce, you still have to bear that cost, and therefore it is to be taken care of. But fixed cost can also be an advantage. How it can be an advantage? When we come to operating leverage, we would discuss it in more details. But fixed cost can be an advantage because with the increase in the volume, you are able to achieve lower per unit cost. You are able to achieve higher profit per unit without increasing selling price and without reducing the cost. And that is what we will understand with the help of a case study together.